How do we remember to identify an account as an asset, an expense, a liability, an equity, a revenue? How do we do that? Well, I have this tool, and it's called Earls. The Earls document is available in the folder section where you found this video, and Earls stands for expenses, assets, revenues, liabilities, stockholders' equity. And really this breaks this down is to say that expenses have a debit normal balance, assets have a debit normal balance. Then it goes on to say revenues have a credit normal balance, liabilities have a credit normal balance, and stockholders' equity has a normal credit balance. Very simply put, debits are on the left side, and there's a Latin root word, debit. Credits are on the right side, and the Latin root word, credit. Very easy, debits is left, credits is right. It's that simple. If we take a look at this picture here, we can see assets, and we have a little diagram here that says asset account, debit for increases, and credit for decreases. The shaded area here says debit for increases. The shaded area means that debit is the normal account balance for assets. Next we have liabilities, right here. Liabilities are those obligations that we owe to people outside our business and those within our business, such as wages payable. Liabilities have a normal credit balance. The normal balance of a liability account is a credit. That's that shaded area. So the credit side is the increase and the debit side is the decrease. Next we have equity. The normal balance of an equity account is a credit. It's in the shaded area. So that's a credit for an increase and a debit for a decrease. Next, we're going to look at expenses and revenues. Expense accounts are a debit normal balance. So the left side is an increase and the right side is a decrease. Expense accounts are debit normal balances. Revenue accounts, right here. Revenue accounts are a credit normal balance in the shaded area. So on the right side they increase and on the left side they decrease. Again, revenue accounts are a credit normal balance. Take a moment and identify the normal balance and type of account for each one of these accounts listed. Example, right here, accounts payable. Accounts payable normal balance is a credit and it is a liability account. I'll give you a few minutes to work on the next few. You can advance to the next slide for the answers when you are ready. So, how did you do? Go ahead and take a moment to check your answers. Push pause on this video while you do that. Let's talk a little bit about business transactions. The following items are business transactions: receipt of cash, payment of cash, events that create a legal obligation to pay out cash or other assets in the future, events that obligate another party to pay you cash or other assets in the future, sale of a product or completion of a service for a customer. This is known as earning revenue. The use of products or services in running your business. This is known as incurring an expense. Very important to notice, use of products or services in running your business create an expense. If we think about the matching principle, we have to match the revenues earned in a period to the expenses used in a period to make those revenues. Very important concept.